Over the years, there has been controversy over which is better for investors, active management or passive management. In other words, having managers that actually do research, analysis, and selection of individual stocks versus investing in the broad indices as measured by the indexes, such as the Standard & Poor's 500 index. As you know, I've been a strong advocate of active management. I believe that there's added value when a manager actually looks at companies, has analysts and researchers that go visit management, when they have accountants that scour the financial statements and look for irregularities. I think that adds value. But quite candidly, the news media seems to feel that index funds are the wave of the future that people ought to adhere to. The reason is that the statistics show that index funds beat about 2/3 of the actively managed funds that exist out there. So why is that? Well, if you understand what an index is, it is really a broad measurement of a segment of stocks. Take, for example, the Standard & Poor's 500 index over a full market cycle. If you look at a full market cycle, the index should be the average of how that basket of stocks performed over an entire market cycle. So, why is it that in the case of the Standard & Poor's 500 index, that the index actually beats 2/3 of the actively managed funds? The reasons are really quite simple. First, index funds are low cost. They're low cost because nobody's really at the helm managing those funds. It's all computer driven. And in many instances, the number of stocks in there are weighted based upon their market capitalization. By contrast, actively managed funds have higher expenses because they're actually doing more. They're doing more research, they're doing more analysis, they're actually visiting companies. And so there is a difference in cost. The second reason is that some stock managers just are poor stock pickers. They just don't pick the right companies and know when to get in and out of those companies in a timely manner. But I will tell you that while we look at things, and while the indexes do beat 2/3 of the actively managed funds, there's still that 1/3 that does better. So why is that? Well, Morningstar has done an analysis, and they've come up with 5 basic characteristics, traits of mutual funds that are actively managed that have actually added value because of these traits and characteristics. Those characteristics are expense ratios, portfolio turnover, manager tenure, manager ownership in the fund, and what type of incentive compensation does the manager or management team get? 2 of those, expenses and manager ownership in the fund, are critical. They're actually characteristics that we've adhered to for many, many decades. Expense ratios are important. And what Morningstar determined is that funds that had expenses that were in the lowest quartile of their peers actually had a better chance of doing better than the indexes. Secondly, when managers of those funds had at least $1 million of their own personal money invested in those funds had a tendency to outperform as well. But those 2 characteristics combined were the primary reasons why 1/3 of the actively managed funds actually do better than the broad indices. When I think about helping our clients manage their investments, to me, it's important to have somebody at the helm. It's important to have somebody who's actually doing the research, doing the analysis, and being active in terms of the selection of the holdings and, at the same time, deciding when to sell those holdings. I will share with you that the mutual fund managers that we use have been managing money for many decades, and that their approach is to buy companies that they truly intend to hold for 3 to 5 years plus. They're long-term investors, and they are incentivized in their compensation based upon the long-term performance of their underlying funds. So, there is truly a difference between active and passive management. And for our clients, I believe they've been rewarded by active management with people who have an interest and a vested interest in knowing what companies they own and how those companies perform, not on the short term, but on the long term. Thank you.